Now, Discovery Communication. The company established in 1985, and then it went through a lot of changes. It was kind of acquiring new businesses, then we were splitting off, then we're acquiring another business and splitting off. And so it's quite a lot of buying and selling within that company happens. And the last one was in 2017. It was a big acquisition, and they acquired several networks, huge networks. And I presume when you understand that this is the way how they grow, there is a lot of goodwill within this company, right? So you have to pay attention to that particular case. By the way, I didn't look previous to masterclass how much of the goodwill they have. The reason for that my interactive broker wouldn't show it to me. I was trying to find it, but for whatever reason, the platform was going through some updates, so I couldn't tell you exactly. But you can do it tonight when the market opens. Interactive broker or other broker will update this information. You can see how much of the goodwill is included in their book value. It is important parameter which you have to consider. This global media company provides content across pay TV, as I said, similar structure as Netflix, free to air. So they show some their programs completely free, and they do it through TV platforms and also websites. And also they generate some revenue through content licensing. It means that they don't own that network, but what they do, they provide content for them, and people kind of pay them, other companies pay them for this and show to their subscribers. And as you can see, this company has subscribers in 220 countries. My goodness, I even didn't know that so many countries existed, and in 50 languages. So it's quite amazing. I mean, the business is so diversified. I remember when we were talking about diversification of your portfolio, and one of the rules, you don't have to put in one particular business, right? Because if you invested in some kind of particular business which deals with one product, remember we invested in Fitbit, and the Fitbit was a fantastic company with the absolutely amazing growth, but they have only one type of product, they watch, and that's it. So if you buy one product, you're not jumping to buy another watch. You have only one watch, and then you don't buy anything else. And the company was growing pretty fast, and then when they faced competitors from both sides, from the cheaper competitors from China and then more expensive competitors with a smartwatch like Apple and Samsung, what happened? They stuck in between, and their revenue dropped down quite a lot. And as a result, the company lost a lot in value. Okay, this is kind of bad business. But when you understand that the business have a lot of products, and people, if they stop using one product, they might switch to another product. It's already good for us. But also, they are not affected by economical changes in one particular country, because they have distribution practically all over the globe, right? So if economy in, for example, in Australia suffered, and you put money in Australian company, even if this company is good, because of general consensus and fear on the market, this company might drop or maybe losing revenue and losing profit. So it's kind of risky. So that's why you have to diversify. But by putting money in this type of business, you're already diversifying yourself, because if one country has a kind of economical recession, so it make money from other areas. Okay, that's what I like. And on the left hand side, left table, the networks and programs which they have in the United States, and on the right hand side, this table, it's the channels which they have outside of the United States. And again, it's in different languages. And probably the most kind of one of the first, it was Discovery Channel, when they talk about this Animal Planet, then the Food Network and something like that. So they quite a few different sporting events, as I said. Some of them suffered because of pandemic, because they couldn't translate, for example, live events, but at the same time they could keep showing the recorded ones. Okay, this is kind of like that. This is about the general business of Discovery. And let's have a look at their value line. Now, for guys who are new, we're using Value Line. Value Line is a company which was established in 1923 in the United States and during the recession time. And the main idea of this company provide unbiased information, fundamental information to investors. Now it is a paid subscription, so it costs from $700 to $1,500, depends on what time you subscribe. The prices constantly change, and personally I love Value Line, and they always provide very good information. And as you can see, information is like for this specific company for the last 12 years, which is amazing, right? So you can see a lot when you're analyzing companies during that period of time and in one glance. Now they have different type of their own parameters. Timeliness, for example, it tells and it goes from 1 to 5, and 1 is the best and 5 is kind of worst, and it tells how much they expect this company is going to move within the next 12 months up, okay, from the compared to other companies within Value Line universe. And it's 3, it means average. So they don't expect a lot of movement, but also they don't expect that it's going to move slower. Now safety 3, it's again some kind of in between. And then beta 0.1, 0.05, it's a bit higher than the market, but not that much of higher, so only 5%. Okay. Now for projections, 18-month target price range, which Value Line expect the price is going to be within the next 1.5 years. So from $19 to $43. Now current price is $20.21, like it was closing price last night. So it's very close to $90. Okay, that's what Value Line believes. Now, if we look for 3 to 5 year projection, Value Line sees the company between $65 and $100. Again, so it means that it's a more than 200% move, which we can expect, nearly 400 up to 400% move if the company performs pretty well. Now, that's their projection. But let's have a look what happens fundamentally with the price, not the price, with the earnings. Now, first line, sales per share, that's what we can see. So what it happens that they look at all sales which happen and then divide by amount of shares. And that's what we see this parameter. So $6, then $6.19, then $6.60, then $8, then $9, then $11, then $14, $15, $16, $18, $20, $20, and kind of the growth you can see even now happens. So all 12 years, there was a constant growth in revenue. So the company was selling more and more and more and more every year, non-stop. Now, and if we look at earnings a bit different, because look, as in majority of cases, we see the growth. And if in 2008, the earnings per share was 40 cents, now it's $2. Like last year, it was $2.8. So the growth happens in general, but some years we can see the drop. So for example, here there was a huge growth from 70 cents to $1.40. It's like 100% growth within 1 year, and then it's kind of pulled back, okay, 126. And then again, growth, and then slight pullback. But in generally, we can see that the company is growing, okay, and only last year, there was a huge drop, like 88 cents, because of pandemic, okay? So that's what's happening right now. Now, the company doesn't pay dividends. I already mentioned in previous master classes that personally I love companies with dividends, especially during uncertain times like that. And I would find the company with dividends, but to be honest, because the market is so high, I couldn't find right now any good company which is undervalued at the same time. So that was one of the few companies which I have in my portfolio, which target to buy it at this week, okay, even like the market is high, maybe not this particular week, but maybe next week or a couple of weeks, but I'm paying attention to this company to put in my portfolio, right? Now, and another thing which I wanted to also show is the common share outstanding. Look, they had previously 560 million of shares, and then slowly they kind of reduced it to 381. So they have a history of buying back their shares. So they are boosting earnings per share just by buying some shares from the market. Now, in 2017, they had a huge acquisition, and they issued additional lot of shares, and you can see it's increased quite a lot here, okay? And now they're going to go and buy it back. You can see already this year, they're going to buy 47 million of shares. back from the market. There is no information about future buybacks, but if you see something like that happened in the past, most likely they're going to do it in the future as well. Okay, the only thing which can stop them from doing that, if they decide instead of buying back shares, they might pay off their debt, which is quite high right now at this particular moment, because they are not only issued more shares, they also borrowed a lot of money in order to do this acquisition. Okay, now if we started to talk on the debt level, let's have a look at debt level. You can see long-term debt here. Okay, we can see that previously, like 10 years ago, it was $3.5 billion, and then it starts slowly growing. Okay, they're not paying their debt back, and in 2017 they borrowed practically $7 billion, right? And we can see that right now the debt is 15 billion. Now, is it a good debt or is it a bad debt? Let's have a look. The total capitalization, so the whole company, if you go now and buy the whole company, you can buy it for $10 billion. And then you understand it, you pay $10 billion, and now you have to pay another $15 billion to the banks, which gave you the money. Okay, and then you can consider that this is whole my company and everything what is in it, it's mine. Okay, and it doesn't owned by banks, because banks, you know, if you borrow the money, it's practically they own the business in this particular case. Now the question for us, because it is quite high, usually I prefer personally to buy companies with capitalization compared to debt on the 20%. So I would say in this case, the best ratio for me would be if it is only has $2 billion of debt, not more than that. Now, can they serve that debt? That's another question which we have to ask. Are they going to suffer? Remember the company which was Asana, and they did similar acquisition, and they bought another company and they borrowed a lot of money. And what happened with them? They couldn't cover their debt. They even couldn't pay interest on their debt, never mind the body of the credit itself. So, and this company, as you can know, a few months back, part of their business, they went through liquidation and bankruptcy. So you have to be paying attention to how much companies producing in cash and are they able to pay that debt. Now let's have a look how much money they're making annually. So we can see that last year, net profit, so net profit is whatever they received after paying all the expenses, all the taxes and everything. It's net profit. So $2 billion. So how many years it will take them to pay $16 billion of debt? 8 years. If they decide to pay it, so 8 years, if they use all the profit to cover their debt, they can do it. Now, they don't pay dividends, so dividends are zero. So it means that they can't do that. They can't put all the profit, if they want, into that. Now, another thing which we have to also take into consideration is, look, it's cash flow, because we have earnings, but also we have cash flow. And sometimes cash inflow, it's lower than earnings. But sometimes cash flow is higher than earnings, because sometimes we receive certain cash, which is not, it's like we have sometimes expenses, which we show to the taxman, which are not real. It's not, it's kind of fake. For example, writing of goodwill, because the company is buying a lot of businesses, they're writing off goodwill and they show the expense, but in reality, it's not money expense. So, and all this money, they still come to the company. So, and as we can see, constantly company has better cash flow than earnings. So last year, if you see, was $2.8 in earnings and $6.2 in cash. Okay, so it's like more than 2 times. So basically, if they made $2 billion net profit, it means that roughly $4.5 billion was net cash inflow into their business. And they can use this $4.5 billion in order to do something. For example, they can go and cover their debt. And when I look at these parameters, for me, it's quite secure. I know that if they make $2 billion and then $2 billion extra dollars, they have cash inflow additional, right? So they can pay $16 billion within 4 years, 4 to 5 years, if they decide to do that. Also, because the interest rate dropped down quite a lot, it's also beneficial for them now. So the interest is quite low. And again, remember that this net profit, it's already including whatever they paid interest. Okay, so it's after interest paid. So as soon as they start paying off debt, the interest start going down, like the total interest which they're paying, and the profitability will go up as well. Now, this year, the earnings dropped, as you can see, from 2 billion to $1.3 billion. So it's a huge drop. Of course, it's increased the amount of years we have to pay for that. But as you can see, they're planning to go back to that level for the next 3 to 5 years. And I presume as soon as this pandemic is over, they will get the full revenue income from other businesses. It's one thing, but also they're probably going to translate, and that part of the business which now was affected, they can get revenue back from those businesses as well. Okay. Now, this is kind of main important which we pay here. Let's have a look at the current situation, current position. We can see that current assets, total current assets, $4.6 billion, and current liabilities, $2.8 billion. So they have $1.8 billion in surplus. So they have a very good, stable cash position, and they have out of that $1.4 billion in cash right now. So they have quite a lot of money. Out of $10 billion capitalization, 1.4 billion they have in cash, which is, guys, pretty good. So if something happens in the future, they will be able to sustain their operational activities, even if the revenue is going to suffer. Okay. Now, if you read what value line says, it's practically probably what I explained you, that the earnings were dropped because of that, and etc. But the main probably part is here. These shares offer robust long-term capital recovery potential. For now, however, this issue is neutrally ranked for year ahead relative price performance. Okay. This is what value line says. Now, earnings predictability is 60%. What it means for guys who don't know, it means that out of 10 times which they tell we're going to make certain amount of money, they're right only 6 times. 4 times they're not right. 4 times they tell we're going to make $1, and then they're making something different. But the thing is that when they're saying we're going to make $1 and then they are not right, they can be not right in different ways. So they can tell $1 and make only 90 cents, but they can say $1 and make $1.20, so more. So the question is, are they usually overperform or underperform? Okay, this is a kind of important part to know. And here I have estimates. At least it's for a couple last years, and you can see quarters. Now the green, it's actual earnings. Okay, and this is the range we can see, right? And out of last couple of years, few times they out of the range, but only once they were under. So only once they made money less than they promised. For me personally, it's kind of a good thing, right? So it means that they usually under promise and over deliver. I know that some companies, especially when we analyze the Indian market from India, a lot of companies there, a lot of CEOs, what they do, they under promise and then they over deliver, and then they kind of get certain rewards for that. Okay, something like that. Okay, guys, we completed the financial analysis here, and another thing which is also good to pay attention to is look at the growth rate. For the last 10 years, the company was growing 12% every year, like in average, when they take the whole growth within the last 10 years and then divide it. So that's the number they come up. So 12% in sales and 14%, 14.5% in their earnings, okay, net profit per share. During the last 5 years, although they have only 10% growth in sales and 7.5%, so it's lower growth in earnings. Now, I believe that major reason for that specific growth, it was an acquisition which happened in 2017, because you probably know when you're buying another business, there is a huge expense, like legal expense and acquisition expense happens there. And usually companies which go in through the big acquisition, huge acquisition, that specific year or maybe even next year, their earnings, they are dropping down. Okay, even the business in general went up. Actually, let's have a look here how much it was affected. Look, in 2017 they bought a new business, their revenue increased, but look, their earnings dropped down. For the last 2 years, their earnings went from $1.9 to $1.6, right? 169. So, but then look, year after that, when the integration was completed, there was a huge jump in earnings straight away from 1.6 to 2.8. And that's what usually happens when the company has integration, like properly integrated with other business. They reduce the cost, they hired or fired unnecessary staff, they closed certain departments. So they integrated to companies, and then it usually goes bust in their profitability. That's what happened here. Okay, this is a good kind of example for that. All right, so guys, what do you think? Can you please put from, whoever already went through our education and you know how it works, can you put, do you believe it's a quality company? Do you believe it's undervalued company? Oh, by the way, before we go for undervaluation, I didn't mention that. Let's have a look how much the company was evaluated in the past and how much people pay for this now. Now, average PE ratio, price earning ratio, we can see that it was 16, 17, 25, 14, 21, 26. During the last 5 years, it was 19 the highest, 13, 14, 15, and 10 last year. Okay, 10 PE ratio 10. Now at the moment it's also 10. So basically the company is now on a sale compared to what it was before. So, and again, now the question, guys, for you, what do you believe? Is this company quality company? And maybe you can give certain points, or is it undervalued company? So what's your opinion based on what we analyze now? Okay, so JIT undervalued, Nona 3 to 4. So it's a good company, not a fantastic from quality, but good. Okay, quality company, undervalued. Okay, you can keep writing your opinion. I'll tell you my opinion. Remember, the reason why I'm asking you is not just because I want to check you. The purpose of these master classes is to kind of to activate your thinking process. Remember, like this proverb when the guy is asking, what do you want me to do? Do you want me to feed you with a fish, or do you want me to teach you how to catch that fish? So if you learn how to catch the fish, you're going to be like completely happy for all your life, because now you can keep you not hungry like for the rest of your life. If I give you the fish, I'll feed you once, but then I will have to feed you again and again and again. So that's the main reason when we go through the process, I'm showing you the way how analysts going through the different businesses, analyze it, and then they make a decision. So you have to assess different parameters. We know that the PE ratio is low. We see our margin, we see our debt level, so we see our profitability level. And then we have to put it all together and think, okay, fine, what kind of company it is? Is it a good company or bad company? And you have to make this decision. Nobody is going to make it because it is good for you, or is it not good for you? Okay, when you're choosing your lifetime partner, right? So you're also considering different things. This person might be very emotional, but then this person is also fun. And if you love this type of personality, so you're going to go and marry to this person. But if you prefer very calm, without any crazy emotions person, so you are going to marry another person. So similar story here with stocks. So if you see very volatile stock and it moves up and down, yes, you can have a lot of profit there, but then you can have a lot of stress there, because if you buy it in the wrong time and it drops 20–30%, oh my goodness, you are going to have a lot of sleepless nights. Okay, you need to learn how to make those decisions, because if you learn how to do that, after that you're going to make money all your life on the stock market.